Have you ever wanted a simple trading system that lives up to the hype and makes guaranteed profits in only a couple of minutes a day? Well, the system I'm going to teach you in this video is guaranteed to make money. It's super easy, only takes a few minutes, is mechanical with no complicated analysis, and best of all, is extremely low risk. I'll explain the rules from the entry to the exit, including which pairs to trade, timeframes, and lot sizes, so you can copy it all exactly and begin banking serious returns in your account starting immediately. What I'll do is walk you through each step first, and at the end I'll run you through a full example so you can see it in practice, and I'll show you where to download the special indicator the system uses for free. But first, let me quickly show you some results so you know what this is capable of. Not only does it have a high win rate with very small losses, but some of the winners are enormous, which is a signature part of this strategy. Oh, and although the system is guaranteed to make money when copied correctly, some people will still manage to mess this up with dumb mistakes. So if you want to make sure you're not that guy, watch the entire video because I'll show you a couple of common mistakes in each step that you must avoid. So let's break this down. Step 1 is the entry, and this is something 99% of Forex traders get wrong. So let me explain why we'll be using a special custom indicator. Most people are so bad they would have more winners using a random coin flick to pick the direction, and it's all because of this simple misunderstanding. If I took all of the information off a chart and only showed you the candles, this looks like every other market like stocks or commodities, and because it looks the same, people think it is the same. It isn't, and the clue is in the instrument symbol. The euro is one market and the US dollar is a different market that both move independently with different economic forces driving their values. It's like the oil market versus the gold market. And when you bring them together, the chart is merely a comparison of the two. If you want to trade the pair chart, you need to know what each individual market is doing first. In Forex, you are always buying one currency and simultaneously selling the other. So it's essential to only trade when the currency you're buying is going up and the one you're selling is going down. And a pair chart doesn't give you that information. That's why we need this indicator. Look at this example. There's an uptrend on the euro-US dollar pair, so an amateur trader enters of my position. But behind the scenes, both currencies are going up. The euro is going up a lot, the US dollar less, and the pair chart shows that difference between the trends. But going long on that pair means selling a strengthening US dollar. That's a really dumb decision, and this is why most traders are so bad at finding profitable trades. Yes, there was a small profit to be made there, but look at what happens if the currencies were moving in opposite directions. When the euro is strengthening and the US dollar is weakening, you are now buying the currency that's going up and you are selling the one that's going down, which just makes so much more sense. And the trend on that pair chart is much, much bigger. That's a high probability trade with a much bigger profit potential. You are going to win more often and make more money on each wing. This is called currency strength analysis. We are currency traders. We're not pair traders. All professionals use this method. It's a totally unique factor exclusive to Forex that makes our market different to all the others. It makes Forex easier than any other market. I'll put a link in the description to another video that explains this in more detail. This is what the indicator that I'm going to give you for this system does. It attaches to your chart as a histogram, but it isn't reading that chart data. It reads the individual currencies data. In other words, it looks at the euro as a standalone market and the US dollar as a standalone market, and then tells you when they are diverging in opposite directions. These are the settings to use for this system, and I won't explain what they all mean in this video because there are full instructions when you download it at the end of the video. Just make a note or come back to this when you set yours up on your charts. And you can see how it relates to the price movements for a pair. When the histogram is green, the base currency is strong and the quote currency is weak and the pair price moves up. And when it's red, the base currency is weak and the quote currency is strong and the pair price moves down. It's a very simple indicator to read. There are different ways to use it, but for this system, we use it in the simplest way and just buy when it changes to green and sell when it changes to red for the entry. Now, I'm going to come back to the entry in a moment because there's a very important factor that you won't understand until we've looked at the rest of the system, especially the time frame to trade. So keep watching and I'll come back to this and give more detail. The next step is the stop loss. A stop loss should be far enough away to allow normal price fluctuations, but close enough to get you out when the trend has changed. Even in a strong trend, the price doesn't move continuously in the same direction. There are fluctuations and pullbacks, so the stop loss needs to allow for that and give the trade room to breathe. You've probably been in loads of trades where you get stopped out and then you watch as the trend carries on without you. You know how frustrating that is. You picked the right direction. It would have been a huge profit, but you got knocked out of it early. That's because your stop loss was too close. And we just so happen to know the optimal distance to prevent that from happening. Researchers at the London School of Economics have conducted a detailed analysis of trends on 34 different pairs over 25 years of data, and they concluded that on all time frames, 3 times the average true range is the optimal distance for a stop loss. So, for example, if the average price candle is 10 pips, the stop loss would be 30 pips. That will give the trade the correct amount of breathing space, so you're unlikely to get stopped out when the trend is continuing, but you will get out early if the trend has changed direction and you've lost your advantage. This isn't perfect, obviously, because the markets are very chaotic, but this is the optimal setting that works better than anything else. And you can use the ATR indicator to tell you what the average true range is at the time you're trading, because remember, this changes depending on the volatility, and this is really important. The system uses a trailing stop loss, which changes after the entry. So although you might enter with a 30 pip stop, it will change as the trend progresses. This is critical for this system, and one of the places where people make mistakes and mess this up. I'll come back and explain this in a moment, so keep watching. First, let me show you the next step, which is the lot size. Most people use a fixed lot size for every trade, and it's the biggest mistake you can make. It makes your losses bigger than they should be and your wins smaller. It's one of the dumbest things traders do. Let me explain. With a $1,000 account, if you enter a 1-lot position, you're risking 10% of your account. I know that's high. I'm just using simple numbers to demonstrate the problem that's hidden from most people. The next trade is risking over 11%. After 5 losses, your next trade is risking 20% of your account, and your 10th trade is risking 100%. And if that loses, you've wiped out your account to 0. Notice the losses are getting proportionally bigger compared to the account balance. During a win streak, it's just as bad. After 10 wins in a row, your profit is half when you started proportional to your account balance. Using fixed lot sizes maximizes losses and minimizes profits. It's the definition of bad money management. The solution is a percent-based model. Instead of using the same lot size, you use the same percent. So again, on the first trade, it's 1 lot, which is 10% of the account balance. But after a loss, the next position is 0.9 lots, but it's still 10% of the account balance. After 10 losses in a row, the risk is only $38 and you still have money in your account. In fact, using this money management strategy, it's impossible to lose your entire account. But the really impressive part is on the winning side. After 10 wins in a row, your next win is over 2.5 times when you started. The percent risk remains the same, but the dollar amount won increases. This is the definition of good money management. It minimizes losses and maximizes profits. So that's what this system uses, a percent-based strategy to decide how many lots you enter with. I'll show you exactly how to do this when I go through the full walkthrough of a trade from start to finish in just a moment. Before that, let me show you the exit and how we take profit. And this is the real magic of the system. Money isn't made on the entry, it's made on the exit. So this is by far the most important part of any system, but sadly, the part people pay least attention to. Everyone is obsessed with when to enter, and they barely even think about the exit. It's so back to front. The best known saying in trading is to cut losses and let winners run. And most people do that by having a profit target that's maybe 3 times the distance of the stop loss. This system does something much more powerful. First of all, there is no profit target. If a trend has the capacity to run for several hundred pips, why limit yourself to only 30 or 40? To maximize profits, you should always stay in the trend for as long as possible, and we achieve that with a trailing stop loss. But no ordinary trailing stop. I'll give you the example here of entering on a 1-minute chart just to emphasize my point. Most people trade in very short time frames like this will enter with maybe a 10 pip stop loss and a take profit of perhaps 30. But that trend that starts on a 1-minute chart is the same trend that grows into an hourly, daily, or several weeks long trend. All trends start on the lower time frames and move up. You've probably heard of the top-down analysis, where people look for the prevailing trend on the higher time frames and then zoom into the smaller time frames to pick their entry. Again, they're focused on the entry and they're ignoring the exit where the money is made. This system does the opposite. We start on the lower time frames and scale up to the higher ones. Let me show you. Let's say we enter as the indicator turns green on a 1-minute chart with a 10 pip stop loss. We let that run for a while, and then we switch up to a 5-minute chart and move the stop loss to a recent swing low. The trend carries on and we search up to 15 or 30-minute charts, and again we move that stop to a recent swing low. What started as a 10 pip very tight stop loss has now widened to 30 or 50 pips, and we keep doing that to progressively higher and higher time frames until we're on the daily charts and the stop may be 100 or 200 pips behind the price. The stop loss is still locked in a huge profit way beyond the typical 3-to-1 ratio of most traders, but it's still open and we're now managing the trade as though we were long-term swing traders. So look at what this has done. First, traders on higher time frames have to wait a long time before the trend is obvious for them to get into. Several hundred pips have already happened before they can enter. And when they enter on those higher time frames, they have to use a wide stop loss to allow for the normal fluctuations at that scale, and that might be 300 pips. And for them to even gain 1% profit, the price would need to go another 300 pips. But for us, we entered right at the start of the trend, and by the time the price has gone up 1% for the swing trader, we've earned close to 60%, and when that trend runs on longer, we can walk away with over 100% return for a single trade. This is the easiest way to make money and maybe super low risk. We enter the trade with a 1% risk, just like everyone else, but whereas they can only make 2 or 3%, maybe 5% max on a move, we can make double or triple digit returns. The crowd are wrong about everything. 98% of traders fail, so do the opposite to them. The other benefits to this are, 1, we trade less often because our trades stay open for longer, which means we're taking fewer risks and paying less commissions. 2, when a winning trade is 10 or 20 times bigger than your losses, you don't need to be right as often. One winner will cover many losses. So being right is nowhere near as important. This is why even beginner traders with very little skill and a low win rate will profit with this system. But of course, with the currency strength analysis indicator, you are going to be right more often than everyone else. So this system is on steroids. Okay, so let's walk through an example of a full trade from start to finish so you can see what to do. But very quickly before I do that, just be aware there are a few critical tips and additional rules that I haven't shown you yet that can mess this up. So after the trade walkthrough, I'll show you them. Make sure you keep watching because those mistakes are easy to make, and without the extra rules, you will mess this up if you don't know about them. Right. We start on a 1-minute chart and we wait for the indicator to change from red to green. This is going to be a buy trade example. Have the ATR indicator on the chart as well to help you decide the stop loss. In this case, the ATR is 3.3 pips, so we multiply that by 3 and we'll just call it 10 pips for ease of this example. Now calculate the lot size to risk 1% of your account balance, and to do that you can just go to one of the 3 calculators on a site like Baby Pips, enter your account balance, risk percent and stop loss, and it will tell you what lot size to use. Put that into your order form and open the position. Now, as the price moves into profit, initially you move the stop loss to break even quite quickly, which will be once the price has gone 1.5 times into profit. Put it 1 pip above the entry just to cover the cost of any commissions, but once it's at break even, leave it there and now switch the chart time frame to 5 minutes. As the price goes up, wait until there is a pullback and then a continuation, and then move the stop loss just below that pullback, and now you change the chart time frame to 15 minutes. And repeat the process. As soon as there is a pullback and continuation, move the stop up and switch to the higher time frame, and keep doing this until you are on a daily chart. And now, on the daily time frame, just gradually move the stop up to each progressively higher pullback and stay with that trend for as long as it keeps making higher lows. Now, obviously, this is the perfect example. It won't always work out this well, but your average wins will always be massive compared to your losses. I promise, this is the easiest way to make money in Forex. Okay, so now some important tips and additional rules to help you avoid messing this up. Don't skip this section because it is the most important part of the video. Number 1, only trade the most active market hours. If you trade this due in the Asian markets, the price on a 1-minute chart doesn't usually move far enough or quickly enough, so you will increase your losing trades. London and New York market hours are the only times you should be entering, and the rule I use is only enter a new position between 8 a.m. and 3 p.m. London time. Anything outside those hours should be avoided. 2. Don't enter a new position close to high-impact news releases. News can cause the price to spike against a trend, so newly opened positions where the price is still very close to the stop are likely to be knocked out. Don't enter a new trade within 30 minutes before a news release. Number 3, only trade the best pairs, and those are pairs that have a large daily range and a relatively small spread. You can use a 3 tool on the website mataf.net to check volatility. At the time of making this video, yen pairs like the euro yen or the pound yen are the best, whereas something like the euro pound would be a waste of time. But included in that is the spread. The pound New Zealand dollar has a big daily range, but it also has a 2 or 3 pip spread. And if you're entering a position on a 1-minute chart with only a 10 pip stop loss, you are much more likely to get stopped out too soon if the spread is wide. So pick pairs with the smallest spread. Number 4, don't enter more than one position at a time. If you get into a trade, ignore the indicator from then on. As long as your trade remains open, that should be the only position on that pair. And 5, don't take any more than 2 back-to-back losses in a day. If you enter a trade and it loses, have a second attempt the next time your indicator gives you a signal. But if that also loses, walk away until tomorrow. Conditions are clearly not good and there's no point taking more risks. Now, the next 2 points are the most important. Without these, the system will not work. The trading stop-loss management that I've explained is not set in stone, and sometimes you need to move the stock differently, and you may even take profit early. The number 1 rule of trading is don't lose money. Protect your account at all costs, and after a loss, you should play it safe and reduce your risk, and this is how you're going to do that with this system. After a loss, the very next trade is going to take profit as soon as you can cover that loss. So if you lost $100 on the last trade, your next trade will take profit at $100. If that trade also loses, and now you're down perhaps $190 in total, your third trade will take profit at $190, and so on. Your aim is always to recover your account back to full balance as soon as possible. This is the strategy that I use, and my account has never gone more than 10% into drawdown ever in over 20 years. Now, I know that means that sometimes you'll take profit at 20 pips, and this is the big trend that carries on for 400 pips, but it doesn't matter. Protecting your account is more important, and if the trend does carry on, you will have another opportunity to enter it the next time the indicator switches color. You only need 1 or 2 of these really big wings to make enormous returns. But if your account has lost too much before that, those wings won't be so impressive. Trust me on this, protecting your account is more important, especially psychologically. The wins will take care of themselves as long as you take care of reducing the loss. When your balance is reset, trade the system exactly as I've shown you in the example, scaling up time frames. But after the loss, take profit to cover that loss. Okay? And now the final point, and this is the make or break factor. The system is guaranteed to make profits if you copy it correctly and you stick to the rules. But here's the thing, most people won't. No one wants to hear this, but trading is not about the system, it's about you. A good trader can make money with any system, whereas a bad trader will fail with every system, even if they were given the Holy Grail. Trading is all about mindset and psychology and your ability to stick to the rules over the long term without making any changes. I give my systems and all my technical knowledge away for free. I don't sell courses because I know people don't learn to trade from an ebook or videos, and it would be wrong to charge people for something I know won't really help them. I don't agree with the so-called gurus who do sell courses. They don't work for most people. What I do is mentor people one-to-one, and so far every person I've mentored has become successful and now makes a full-time income from trading. I've got a 100% success rate with my clients, and I even guarantee that as part of my mentoring. If you work with me, you will become a profitable trader, guaranteed. If you want that, visit my site to find out more. I would love to speak with you. But whether you do that or not, please, with this system, put your energy into your mindset. Focus on your emotions, managing them, learning to cope with the fear of missing out, revenge trading, and so on. Work on your discipline. This system will make money for you if you stick to the rules. That's all that matters. Trade it perfectly for a month or two and come back and let me know your results in the comment. You will be in significant profit if you stick to the rules without changing anything. And that's what most people can't do. So please focus on that more than anything else. Finally, the last thing is the indicator. There's a link in the description where you can sign up for my free newsletter, and I'll send you the download and a full set of instructions on how to use it. I'll also include some links in the description to a few other videos about individual currency strength analysis, as well as the percent-based money management if you want more detailed explanations on those topics. If you've enjoyed this video and you found it helpful, I'd really appreciate it if you would subscribe to the channel, like it, leave a comment below. If you've got questions about the system, ask in the comments and I will be more than happy to answer and give you any help that I can. Thanks, I'll see you next time.